Hello everyone, I'm John Cunnison. I'm the Chief Investment Officer at Baker Boyer Bank, and I want to welcome you all to this month's Market Update. Today we're going to be talking about a concern that I'm hearing from clients and that I'm reading in headlines, and that concern is stagflation. Now, what is stagflation? Stagflation, the word is a combination of stagnation and inflation. So it's the idea that we would have slower growth and higher inflation. And this is something where if we look at the upheaval that we've seen over the last 50 years, and you can go through 2008 and 1973 and the recessions of the early 80s, COVID and the crisis in Europe. But one thing that we've seen very little of is the combination of those two things, right? Recession and inflation together. Now, this is something that I think we're justified in being concerned about. If we look, in the late 1970s, there was a historian named Theodore White, a famous historian, and he wrote about stagflation. And what he said was, conversation everywhere was stained and drenched in money talk by what it cost to live and what it cost to enjoy life. People winced and ached. Some mysterious power was hollowing their hopes and dreams, their plans for a house and their children's college educations. So I think he captures very well all the reasons, the pain that stagflation inflicts on an economy, right? And it's also something that's very difficult to deal with through policy. Right? This is the one thing that the Fed fears quite a bit. So where is this fear coming from? And is it justified when we look at the numbers? Do we see recession in our future or inflation? And if we do, or let's assume that there's some stagflationary impulse in the markets, what do we do about it in our investment portfolios? So let's begin by talking a little bit about growth or the potential for recession, negative growth. When we look at the official numbers, if we just simply look at the U.S. economy, it remains resilient. So when we look at the very first quarter, we had an actual negative number for the first quarter of growth. But it was because there were a lot of imports that came into the U.S., and imports are actually subtracted from GDP growth for reasons I won't get into. But before the tariffs were enacted, a lot of companies rushed those imports in advance of the tariffs. That caused a negative print. If you strip that out, you end up getting a reasonable growth number. And in the second quarter, we'll get that number on July 30th. The second quarter, most economists are predicting somewhere in the high 1% range. If we look at a nowcast, which is like a forecast, but it's looking at current indicators, this is something that's run by the Atlanta Federal Reserve, the nowcast suggests that we're currently growing north of 2%. Right? So right now, if we look at the official data, there is nothing in the official data that would suggest that there's an impending recession. Maybe some slowing growth, but at the margins, not dramatically so. So where is this fear coming from? A lot of it is coming from just policy uncertainty, right? And when we think about what causes a recession, what typically causes a recession are companies that are beginning to scale back on investments in the future. Why? Well, they're uncertain about the return that they're going to get from those investments. Right? And when they begin scaling back those investments, they begin hiring fewer people. That causes the unemployment rate to begin to creep up, and that causes less consumer spending, and that's generally speaking the way we see recessions begin. So a lot of this concern about the future is caused by policy uncertainty, but that uncertainty, I think it's really important to note. When we look at markets right now, we're seeing equity markets at record highs, right? The S&P 500 at a record high. Why? I think right now what the markets are pricing in is that Trump will chicken out. Many of us have heard about this taco trade, right? Taco stands for Trump always chickens out, right? And this is the idea that Trump's going to announce these big tariffs, spook the markets, prices go down, and then, we'll see a renegotiation and prices go back up again. So it's really important to note that a lot of the policy uncertainty is what's causing fear about future recession, but it's important to note that that is uncertainty, policy uncertainty, and it could go both ways. And what we've seen so far is that a lot of it is being negotiated back. So when we look at economic growth, I think looking at official numbers and what we've seen so far, there's no indication of an impending recession. When we look at inflation, what do we see there? When we look at inflation, the official numbers are showing tremendous progress, compared to where we were 5 years ago. Of course, we were above 9% at the end of 2021, beginning of 22. We're now headline PCE inflation, which is what the Fed uses. Headline is 2.7%. Core, where we strip out food and energy, core is at 2.4%. The Fed's target is 2%. We're almost there. Right, and making progress in that direction. The one sticky thing is shelter. So housing is keeping those rates, up above the target for the Federal Reserve. So current data suggests that inflation is not a problem right now. When we look to the future, again, it's policy uncertainty, particularly tariff policy, that is causing many to fear that there may be an inflationary impulse in the future. Right. But that remains to be seen. How much inflation also remains to be seen. But right now, there's no reason to think that we're, headed into a stagflationary future. The other thing I want to point out when we look at inflation and where that fear is coming from, if you look at this chart, I think it's fascinating. This chart shows two versions of inflation. The blue line is the one I was just discussing before, right? This is showing the year-over-year change in inflation in percentage terms, right? And you can see that blue line where it went up really high in 2022, and then it's come back again to these much lower levels, what I just quoted. This was what I would call, and what it shows in this chart is Wall Street inflation, right? But what do you and I experience at the grocery store? We experience Main Street inflation, and that's what's in the yellow or the orange line. And that orange line, it doesn't show the change year over year. It shows the price level, right? So, my burrito at the taco truck used to cost $7. Now it costs $13, right? The year over year change in the price of my burrito may be going down to more normal levels. But it still costs $13, and I'm not used to that. It doesn't feel good. It doesn't feel good to any of us, right? So this fear of inflation, I think, is kind of on people's minds. And when we look at consumer survey data of expectations of inflation next year, they're quite high, in the 5 to 6% range. So people are fearing inflation. This tariff uncertainty does not help that. So when we look at the potential for stagflation, right, let's just assume that there is a stagflationary impulse. What does that mean for our investment portfolios? I think this chart does a good job of showing what we've seen historically. Now, this chart on the vertical axis, it shows growth, economic growth, right? And this chart is showing periods that go all the way back to 1930. So each of those dots that you see on this chart corresponds to 1 year in the U.S. stock market going back to 1930, right? So you should see something like 94 dots on this chart. The green ones are years where the S&P 500, the U.S. stock market, had a positive real return, right? It had a return above inflation. The blue dots show years where the S&P 500 had a return below inflation, right? So a negative real return. And then we can see where those dots fell. Now, there's basically, we're looking at, in the upper right corner, inflationary growth. So this was a period where, in most of the 94 years that we're looking at here, most of them, 76 of them, in fact, fell in that upper right-hand corner box, right? Inflation and growth together. And we see a whole mix of things. Sometimes the stock market was negative, sometimes it was positive. Now, what we're talking about today is stagflation, It's in that lower right box, right? And this was a period where we saw both lower growth or negative growth and high inflation or rising inflation. And what we saw was that over those 94 years, 12 of them were stagflationary. And of those stagflationary periods, only 4 of them saw a negative real return. Another 8, we saw a positive real return on the S&P 500. The story that I think we have to take from this is stagflation does not mean run for the hills in your investment portfolio. What it means is be thoughtful, right? So stay the course does not mean set it and forget it, right? Stay the course means let's think about our equity allocation. Now, when we think about, when I say equities, I mean stocks, of course. And when we look at that stock portfolio, it's really important to think about diversification. What's causing some of these fears is tariff policy in the US. Well, that's caused a lot of international investors to rethink their US stock purchases, right? So they've been reallocating back to their home countries or to other places in the world. So year to date, we've actually seen international stocks performing incredibly well. And a big part of that has to do with the currency effect. So it's just important that we remain invested, but we remain diversified and think about that allocation. When we think about fixed income, one of the biggest concerns, when I say fixed income, I mean bonds, right? The other part of the portfolio. One of the big concerns is if we were to see inflation, we're likely to see interest rates rise. And if we see interest rates rise, that's not necessarily a good time for bonds. We last saw that in 2022. So for people who had lots of bonds, you know that that was a painful time period. So if we saw rising rates, that wouldn't be great for bonds. But what does that mean for us? Well, we have tools at our disposal to mitigate those risks. Simply own shorter bonds, right? Don't have long maturities in our bonds. So we have tools to mitigate those risks. If we see a period where we have reasonable growth, inflation isn't the big problem that many expect it could be, the bond returns are likely to be quite strong. Because right now, interest rates, the income that we get from our bonds is higher than inflation, and that's a good sign that we're getting a real return on our bonds. So right now, I think what I want you to take from this video is there are reasons to fear stagflation. But when we look at the official data, there's nothing to indicate that we're headed into a very stagflationary period. And even if we do, when we look historically, stagflation has not meant necessarily a really dire period for investment portfolios. It just simply means we need to be thoughtful and not abandon all the things we know about good portfolio construction. If you have any questions about this video or anything else, please reach out to a member of your Baker Burger team or any member of the portfolio management team. Thanks for joining me.